Hello, and welcome everyone to today's digital live event, the Institutional Investor's Perspective, the Reactivation of Commercial Real Estate Investment Management, presented by AppFolio Investment Management. My name is Ashkán Zandieh, Chief Intelligence Officer and Global Head of Real Estate Tech Intelligence here at CREtech, and I'm excited to be your host today. We're excited to be partnering with AppFolio Investment Management, a leader in cloud-based, all-in-one real estate investment management software solution. AppFolio Investment Management provides an on-demand, one login platform providing flexible and powerful tools to streamline fund and syndication management. Created by the award-winning team behind AppFolio Property Manager, this modern and intuitive software is designed to automate the day-to-day, increase productivity, increase and grow and accelerate your growth and impress investors. In a few minutes, we will hear from the most insightful and active leaders in commercial real estate as we discuss the reactivation of commercial real estate investment management. Our discussion will shed light on what every owner, investor, and manager needs to know in order to grow their business in today's complex business environment. Throughout today's conversation, if you, our amazing audience and community, have any questions, please submit them using the Q&A button located at the bottom of your page. We'd love to hear from you. So please submit them early and often because questions are answered on a first come, first served basis. With that said, I see we have a large crowd gathering already. So let's get the show on the road. Up first, Michael Sebastian, Industry Principal at AppFolio Investment Management, Will Thompson, Vice President and Principal at Fairlawn Capital, and Jeffrey Koch, Chief Innovation Officer and Chief Information Officer at Mill Creek Residential Trust. Gentlemen, welcome. It's a pleasure to have you. Hope everyone is well. Let's get the show on the road. Guys, where are you guys dialing in from today?
Mike Sebastian, I'm with AppFolio Investment Management. I'm talking from our headquarters in Santa Barbara, California.
Nice, man.
Hi, I'm Will Thompson with Fairlawn Capital, and I'm calling from our headquarters in Champaign, Illinois.
Awesome.
Jeff Koch with Mill Creek. I'm calling from my home office in Dallas, Texas.
Nice. Guys, we obviously know what's happening in the world. There's a ton of questions regarding investment management, especially in this environment. As cities around the world begin to reopen, tell me, what are you guys seeing in the market?
Well, I'll go first. So we have hundreds of clients and I talk to a lot of companies every day, and we continue to see multifamily performing well and being a favorite asset class. And I'm sure we're going to speak to a lot of reasons for why that happens over the next hour. I think obviously industrial is very popular. Over the last 2 to 3 months, everyone's been doing online purchases, so that requires industrial space. So you got Amazon and Walmart and lots of others. You've got another up and coming is infill last mile logistical industrial space. So there's a lot to look for in industrial, but I think there's also a lot of opportunities I'm hearing about in office space. And I think we have some questions we'll answer as to why that is over the next hour as well.
Mike, Will, what are you guys seeing?
Yeah, so on a micro level, just in our organization, we've seen a huge surge in leasing activity just in the past 3-4 weeks, especially with student properties. We have a large concentration at University of Illinois, as well as Illinois State. And student has taken off right after the universities announced that they were going to open. That's what we had hoped for, but we're starting to fill up really quickly. Across our entire portfolio, I'm seeing a lot more interest in one bedrooms, which I think kind of makes sense right now. People may want to be living by themselves, and more interest in remodeled product versus sort of the classic product. We've restarted in-person tours, which we had stopped in mid-March, and although we're using masks and social distancing, but we're trying to get back to business as usual. I'm also seeing people relocating from larger metros. We have a large concentration in central Illinois, in Indianapolis. We're seeing people from Chicago wanting to move back home or to get to a lower cost metro. So that trend is starting to play itself out. We're seeing higher show to lease ratios. The people who are out and about shopping are serious. They're not just looking, they actually do want to move and need to move. At the same time, we're seeing renewal rates skyrocket. People who don't want to move are happy to stay. And we have one in particular property that is around 300 units in central Illinois. And just in the second half of June, we had 53 renewals, which is about 17% of the entire unit base renewing in just 2 weeks. To take advantage of staying in place and being happy. So we're trying to push that as much as we can. Around town here, people are out eating at restaurants. I'm surprised at how much people are trying to get back to normal. Fortunately, Illinois is seeing a lowering case count, so we're fortunate in that case. And I'm seeing sort of mixed reactions to mask wearing. It's interesting how some people are all about the mask and other people aren't. Though, again, in our state, it's looking up. So that's kind of the gist of what we're seeing here.
Yeah, that's interesting. Jeff, are you guys seeing the same thing? Because you're in Dallas, and super high growth, and just seeing the flight patterns in general coming out of like urban core markets like New York, LA, SF. We're seeing a lot of activity just in terms of mass transit going to Dallas. What are you guys seeing on your end?
Yeah, I mean, so all of our communities are operating. All of our construction jobs are in construction, so nothing's on pause or stopped or anything right now, which is great. For that, we're seeing rents stabilized, and so we're not seeing a downward turn there on rents, which is good. Across the portfolio, we're still leasing offices closed, but we are looking at the reopening plans and how those operate. So we were still doing self-touring, working with all of our prospects on that, but we're seeing a huge uptick in that, which has been great. Renewals in a good state too. So I think there's a lot of positives that we're seeing as signs of recovery as this goes forward. I think what we'll see is if a second wave of coronavirus comes through and what that looks like, what that will do. I think everyone's planning for contingency plans around that. But as of right now, we're seeing the uptick in a lot of those things and things being able to be open and operating and to move forward for our residents. So we're hopeful.
Yeah, it's awesome. So we can't talk about, so we're talking about a market uptick and an increase in activity and showings and rental activity and others. But we're still in an economic downturn.
Yeah.
How long do you think this will last? And how does it impact
I have my own
portfolio?
personal opinions. Yeah, I have my own personal opinions. And I look at this from an interesting perspective because I look at it through the lens of technology, right? So I'm not the guy raising the capital. I'm not the team running the leasing operations. I'm the one enabling them through technology in both of those. And so my perspective is very interesting in sometimes the hesitation towards technology during this downturn. That I think we're seeing across the board of, is it the right investment? How do I really justify wanting to do that extra spend if I don't know our business is going to produce the revenue we want it to, et cetera, right? And talking to a lot of my peers around the industry, this is a common theme that's led to this idea that there's some sort of a downturn occurring right now, is people are pumping the brakes on major investments and really wanting to understand, can we make that investment net neutral? Does it replace a cost, bring a cost savings? And so it's a lot of work to develop the return on investment strategies to make sure that people understand the value that's created through the use of technology in this space too. So I think it's an interesting take. When I look at it and I see where we're at in the marketplace and where we're going, I mean, I still think we're out into Q1 of 2021 where you start seeing that uptick really occurring. And clearly the way to promise a vaccine or something else that really provides that assurance to the general public that they're going to be okay. I think this fall is going to be very telling with the reopening of schools and how that transpires and how that affects the general populace and where the things go back to normal at that point and what that looks like. So I think there's a lot of things that we'll uncover as to what that time frame really looks like just over the next few months.
Love that perspective. Will, what are you guys seeing? Like, how long do you think this market downturn is going to last? Like, talk to me for a second.
Yeah, not being an economist, it's really just kind of what I'm hearing and what I'm seeing myself. I've been glued to CNBC, just trying to get any kind of glimmer of information. It changes daily. I'm fortunate to have participated in quite a bit of sort of market research and brokers trying to get a pulse on the market, and they share the results of that. It seems like the consensus is that GDP may be back to where we were or close to it at the end of 2021. I think the stock market will probably precede that maybe by 6 months, but anybody's guess is as good as the next. I think it, as Jeff mentioned, it really depends on the control of the virus and the vaccine timing. I think there was some good news this morning out of Pfizer on that, but it's still a ways away. At the same time, there could be ripple effects. There could be effects on retail and office that prolong in different sectors, major bankruptcies of companies that were thought to be very strong, perpetuating the downturn. So I think that different sectors will recover differently. In terms of real estate generally, I think that we'll see a cap rate rise in the near term gradually, but again, I think more in the medium term, we're going to start seeing some inflation with all of the money that the Fed has pumped into the economy. And what does that do? I think that drives investors to real assets, including real estate. So, in the medium term, we may see a pretty strong rebound, depending on how investors are looking generally at different investment opportunities. Fixed income is not going to be, in my opinion, there's not a whole lot of upside left with rates as low as they are. So, we're looking to our investors and saying, real estate, we're in workforce housing, that's the place to be. So I think that once we kind of get through this virus, real estate is going to be a good place to be over the next 3 to 5 years.
I 100% agree. Mike, you have hundreds of thousands of clients. I'm curious to hear what your clients are saying in terms of market activity. What are they saying? What are you seeing on your end?
Yeah, I think, we're kind of in a unique position because we talk to a lot of different types of clients in real estate every day, and we have a big customer base. And so I would say that, in terms of how long the market downturn is going to last and all this, a lot of the predictions are predicated on a vaccine or a viable treatment. And from what I've read, there's something in the order of like 130 plus different treatments by different companies all over the world working on this right now. There's at least a dozen or more vaccine options with different strategies. And I think we're going to start seeing something, you see a little bit of trickle of good news coming in now and then. And I think the market's going to price this in before they're fully released. But for real estate specifically, what I'm hearing is there's naturally going to be a little bit of a lag in that. And I think the reason is that, you still have some distressed assets out there, obviously in retail, right? And office space perhaps. And so I think it just takes time for those tenants that are not paying rents to work through the system. These tend to be clustered in areas, so not every is affected like this. But you do have tenants that are going to have to work through the system. Once that happens, then the loans that are maybe distressed or the properties are distressed, they're going to have to work through the system. So that's going to cause a natural lag just working through the system. So I would expect from what I'm hearing and who I'm talking to that, we'll probably see some of these opportunities pop up on the market towards the end of the year, maybe early next year. And we have a lot of clients that are looking at this as an opportunity and getting ready to start fundraising for it if they're not doing that right now. So we see this as an opportunity, and we have a lot of clients that agree with us, I guess, because they're coming on board, that are looking at this as a time to prepare for the next coming 6 to 12 months.
100%. Cash is king, and it's really interesting. We've been seeing on our end from owner operators, from urban core, they're not investing right now. Investments have kind of halted in major urban core markets. We've seen an uptick in, to to Will's earlier point, student housing has been an interesting sector to watch. And to Jeff's point as well, multifamily residential has been one of those sectors that's been really interesting to observe, and the allocation of human capital and the shifting of human behavior has been really an interesting one to watch. You start seeing the stats pumped up by these residential search engines, and it's really interesting to see where people are starting to look and where the investment opportunities are popping up. So really interesting time. And speaking of asset classes, whether it's industrial, multifamily, commercial office, I mean, like the list can go on, but what asset classes do you think will perform the best over the next 6 to 12 months? Jeff, I'll lead off with you. Love to kind of get your perspective on that.
Yeah, I mean, I do think multifamily is leading it right now, and I think they will continue. I think what's interesting is through this process, you probably have seen the press release that Mill Creek closed a $400 million fund with QuadReal, a Canadian investor. And so we're clearly seeing that people are still going to be pushing forward depending on the type of return and opportunities that are there. So I do think that multifamily has a leg up in this process right now. I mean, just the general stats that were out a year ago, I think are still the same, that there's like over 300,000 apartments needed across the US over the next 20 years. Each year, we need to build 300,000 new units. And so there's definitely demand there for the multifamily space. Outside of that, I was reading just this morning an article that was talking about how hospitality will be back up and running within a year. And so the hopefulness tied there to hospitality, because as soon as you have some sort of a step towards vaccine or control or whatever it is, flights will start happening, people will start traveling again, and that will clearly be a direct impact on hospitality. So I think we'll see that. Retail, I think, is going to take a little bit longer, depending on some of the nuances there of the downward trickle that has occurred. And honestly, consumerization has changed the way that people buy and think about how they buy. So I'm very curious to see the lasting effects of the innovation and ingenuity that's gone into the process of curbside services that now change the way that retail operates. And so it is interesting to see if that is a long-term effect of people's buying habits or a short-term effect. But I think we'll see that as a later class to improve.
Yeah, I agree with you on the retail front. Seems as though like retail has had its doomsday for the past 10 years, and it's really interesting to see how the restaurant businesses have fared throughout not just the past 10 years, but also through the pandemic. And something interesting I saw was the rise of micromobility tied directly into last mile logistics, especially in major urban core markets like Dallas, like Austin, like Chicago, like New York, LA, San Francisco, to facilitate, faster delivery times, because people are still living in those cities and people still need services. So it's really interesting to kind of see that front as well.
Mm-hmm.
Will, love to get your perspective on that too. What asset classes do you think will perform the best?
Yeah, and I'll go back to some of that research I had mentioned that I'm fortunate to have been able to review. And I think the consensus out there is Class B multifamily will be the top performer. If you think about it, they're sort of sandwiched in the middle between Class A and Class C, and people are moving up and moving down, and it kind of has that fortress position. So I do agree with that. I think that'll do well. Also, true affordable, so some type of government housing is thought to be one that will have a sort of a baseline stability, as well as seniors housing. And I think that although there was some concern around spread of coronavirus, I think that there's just a need for that, an undeniable need. And I think those three will outperform. Outside of multifamily, industrial, as was mentioned, I think that will continue to boom, and we don't play in that space, but I wonder at what point is it overbought? I mean, with all the Blackstones of the world coming in to try to buy all of it up, I wonder sometimes about those valuations. I think the office and retail will lag. We talk here, I mean, we're in an office and we say, well, do we even need the office anymore? And although we own the building, so we're not going to leave. And so I wonder about that. We have a little bit of retail. It has struggled in the past 3 or so months, but we've focused on internet proof type service-based retail, neighborhood retail. And, you know, our thesis is that will still be needed. People will still have to go out and get their nails done, get their hair cut, eat at a restaurant, that type of thing. There's also, you know, I mentioned Class A may experience some softness, and although I don't have any personal experience with that to know one way or the other. Where we do play is in the Class C space, and honestly, that could go in any direction. It's really, really hard for us right now. Although the data we have internally would suggest strength. We really had a lot fewer residents ask for deferrals, pending evictions or backed up evictions. We don't have a whole ton of that. And
is that because of price point? Is that a price point? Is that a price point issue?
Well, I would say our average 2-bedroom rent is around $700 a month, and it's really just basic housing. And what was nice about the $1,200 stimulus is that could get you, you know, about 2 months worth of rent, although that pays for nothing else. So it was, you know, in comparison to a place like New York City where you might be paying $3,000 a month for the same. So we felt that put us in a better position. But I think people have to get back to work. And if you don't, then, you know, we'll start to see maybe after July as the extended unemployment benefits. And if there's no extension of that, we may see a backlog of it. But even so, I mean, people are paying on time. We turn late fees off right away, and people are still paying pretty much on time. But there are just a lot of factors at play at the sort of the at-risk bands of income, you know, that $35,000, $45,000, $50,000 level. And it could be regional, right? As we had mentioned, it's, and maybe the Midwest is stronger than some of the coasts because of people shifting around, and we're still bullish about it, but it's, I see mixed reactions out there in the market about how Class C will do. And as you mentioned before, one place where I disagree with the consensus is on student housing. I see a lot of commentary on it will not perform well, but that's not been our experience. And we have a number of complexes that service community colleges, and my theory is as unemployment goes up, people go back to school. And so we're going to see an influx of that. And we have seen an uptick in applications that's consistent with the university traffic. But I think student will remain solid. If you look back to the last recession, it outperformed other asset classes. And I think that whatever we're in right now, if it's similar at all, student housing will have a similar, the luxury again may suffer, but that core of good, well-located student housing, I think will fill up and remain popular and full and perform well.
100% agree with you. It's super interesting to see, not only just the general universities, but also business schools also no longer needing for you to take the GMAT or apply even with the GMAT, you know, to even apply. I think that will also lead to a boom in student housing, especially amongst professionals, which is really interesting too. 100% agree with you. Jeff, I think you have a comment there. Your thoughts?
Yeah, I mean, I'm curious because, you know, you've seen different universities taking different approaches about this fall. Do you think that's a temporary change where they may have some e-learning approaches versus the continuing on-campus activities? What do you see as that trend and how that impacts student housing? I'm curious if you guys have done more research around what individual universities are doing.
So our theory is that the major universities, the big ones, the 50,000 pluses, they will actually, you know, enrollment will increase more than everyone expects, because some of the universities that are maybe Western Illinois or Southern Illinois, maybe those struggle and students start wanting to go to the main universities. And although there is an uptick in e-learning, I did my MBA at University of Illinois, and the second year was all online, and I didn't notice any difference in quality. But there is no substitute for a 4-year on-campus education. Yeah. I mean, an 18-year-old is going to want to go do that, and it's the experience, it's the growing up, it's the life lessons. So again, it's the larger universities and that undergrad population, grad school, I think, will be the leader in the shift to online. And I still think we'll see large student housing operators build luxury housing. As long as it's well located, you might see a flock closer to campus as opposed to building farther out. But again, I mean, in the near term and even the medium term, we still, that's kind of the way we see it going.
Okay.
Yeah, I love that. 100% agree. So, speaking of shift earlier we touched upon this, but we talked about a shift in demographics. What do you think about the pandemic having any near or long-term impacts on demographic shifts? I'd love to kind of get your commentary there.
Well,
Jeff,
I can talk a little bit about some of the things that I've been hearing. Yeah. So, as the millennial generation continues to age and start getting into family building zone, I've read and heard and talked to people that suggest that these families are going to start moving out to suburban areas, as generations always have, and so there's going to, that kind of speaks to the need for multifamily and single family home rentals, as well as home purchasing and building. I would also say that that will probably have an impact on suburban office space. So it may lead to decreased rents and things in the urban. Who knows? I mean, it's something to think about. But that's a demographic shift that I think would drive that office space need, as well as the multifamily and single family home need in suburban areas. It's interesting to think about what the post-COVID world would look like in that space, because you can argue that there's always, just like you're going to want to go to the university to have that experience, a lot of people want to also be able to be in an office around people. And so they're still going to always need office space, but perhaps it's going to be less dense. So that means more office space. So that argues that over the longer term trend, office space may still be a good investment and continue to increase there.
I've been studying the demographic data for a while, actually before COVID, as it more related to transportation. So as Uber started innovating in Uber Elevate, and we started looking at where they would be building their epicenters, how Uber Elevate would work, which Uber Elevate's the helicopter flying service, right? Autonomous of the future. And so we started thinking about, does that geographically change where you want to develop, multifamily assets? And it's because, are they going to be further out and then they want to come into a city center? If you have a helicopter that can transport 4 people, 6 people at a time, that doesn't really change a whole lot, right? But if you get to these Chinook type helicopters that are transporting 50, 70 people at a time, does that change where city centers are, the urban core, what that looks like? So we were tracking that. And then coronavirus hits, and you start hearing about these trends of people that are at the big tech companies that are like, well, now I can work from anywhere. I don't need to be in downtown San Francisco. I don't need to be in downtown New York. I want to be in the country where I can go hiking after work or skiing or whatever it is, right? Is that a trend, or is that just a temporary flux? Is that really a bigger group of people, or is that just a few articles written about a few people? So I think that's still something we have to unveil through the data. And I think that's something that's going to be very understanding of how the demographics change as time goes on. And then the question becomes, do the two marry themselves together of the effects of COVID and the future of transportation? And what could the impacts around demographics be in the general location of where people want to live and how they want to live? So I think it does put in people's minds the thought of what matters most. Is it family? Is it friends? What is it? Is it work? And had people asking that question themselves. And so does that turn into some sort of reality that we just don't see yet? And we have to watch the data to see how it unfolds.
Love that perspective, Jeff. So speaking about, okay, so we have step one, we've identified the demographic studies and opportunities there, but as companies like yours begin to reactivate their investment strategies, are there any specific regions you expect to be high performing that you are focused on, or is there something? We'll avoid the conversation about areas to avoid, but where are you guys seeing the greatest amount of opportunities for these investments?
So I'll jump in, and so our general growth strategy is to stay within a certain radius of where we are, and we are management focused. We want to be very good managers of property and stewards of the property, and that requires us to be hands-on and close to our assets. And so we're in Champaign. We're focused on St. Louis and Indianapolis, and perhaps the southern Chicago area, and then maybe out to Cincinnati and some Western Ohio markets. So we're kind of, radius focused, and it's not that we're going to go chasing Charleston if that's the next hotspot, or the next Nashville, or the next, Houston, or so forth. And so
Williamsburg, Brooklyn.
Well, those are fun places, but for us, we think it would hinder, being best in class managers. That said, as I mentioned before, we are starting to see, we have properties in Indianapolis, and our application, it says, where do you live now and why are you leaving? And a lot of it is like, I live in Chicago, or I live in Minneapolis, or I live in Dallas, and I'm moving home to be with my family, and I got laid off, and I found a job in Indianapolis, the lower cost market. So I do think we'll see some of that. I don't think the city is dead. I think that there's a lot of value there, but I think that the value proposition, people have been at home in a tiny box thinking, I need more space. This is just not life. So I do think we'll see a dispersion of people out into lower cost metros. We're in the Rust Belt, and that's, fortunately, we look at history and think, okay, well, we think that a lot of these cities have kind of already hit bottom, and now it's just upwards. And what is driving that? Well, you look at Columbus has become a huge tech hub. And where else can that have? Pittsburgh, where else can that happen? And what is a driver? Indianapolis is a huge transportation hub. You think of the rise of Amazon, you think people have to get their packages, and they have to be driven to their house. So transportation is a big one. Healthcare is a big driver of jobs in some of these maybe downtrodden or cities that haven't had so much of the growth in the last decade. So, I feel good about us being in the secondary, tertiary markets. We're not going to see 10% rent growth like you see in some of the coastal cities, but for us, 2 to 3, going from 2% to 3% growth is a huge advantage. And so, we're bullish on our little markets here in the Midwest.
Love that. Mike, are you guys seeing the same thing from your clients as well?
Yeah, I would say, who I've talked to, they're really focused on areas outside of the big metros. So you have people migrating out of big areas like California and New York. So they're focused on areas where those people are moving to, like Texas and Nevada and other states. And that seems to be the strategy, and specifically focused on some of the asset classes we've talked about, obviously multifamily and office and industrial space in those areas.
That's awesome. So we can't talk about real estate without talking about deal structure, and we can't talk about it, especially in this environment. So I want to kind of just really kind of get everyone's take on this. So we're in this environment where how you underwrite assets and the technology and the metrics in which you use to underwrite have shifted. Love to get everyone's perspective on what deal structures are you using moving forward? Like, how are you underwriting these deals if you are making these deals?
I guess I'll jump in with a couple of thoughts. So right before COVID hit, we were gearing up for a traditional style fund. It would have been our first of that nature. Normally we are a deal by deal type firm or a grouping of deals together. And then COVID hit, and we put a pause on that really because of flexibility and investor uncertainty. One of our largest investors is a restaurant owner, so he said, guys, I've got to focus on my business. It's hard for me to commit to a certain number of dollars over a certain amount of time. So we've backed off on that. And I think that gives us a good opportunity to maybe go pick off a distressed deal or do something stabilized that's undervalued. So we've kind of shifted for flexibility, and we are seeing some really good deals come out.
By
right
stabilized, you mean rent stabilized or stabilized as in the asset stabilized?
Well, yeah, 95% occupancy.
Yeah.
Rents might be a little under market, but normally, our best kind of deal is one where there's low occupancy and some physical upgrades needed. Normally, it's a pretty deep value add. So when I think of something that's stabilized, it's full and decently well run. Still some upside, but not a heavy lift. But in terms of like legal structures, we're actually working with a couple of existing owners on buying into their ownership entities, and maybe they want to retire, but they don't want to give up the cash flow. Maybe they've been rocked by what's happened and they want a new sponsor, new operator, maybe some fresh capital, but they like the asset and they want to stay in the asset class. That's not something we've ever done or even thought about. And now I have 3 or 4 deals that have come that way, where they just want it professionally managed, but they want to stay in as an investor. And so we think that's valuable for our flexibility, not having a fund that boxes us in. We can do something like that. And then lastly, crowdfunding is something we've looked into doing. This was a little bit pre-COVID, but I think that more and more people who aren't necessarily ultra high net worth individuals are wanting to be in this space. And especially we typically do smaller deals and more interesting, maybe they have some hair on them. And that can be an interesting way of increasing our investor base and still growing the portfolio. And then finally, the 1031 exchange is something that we've not done a whole lot of, but again, older investors are looking for places to keep money in the market, but not necessarily in the same asset. But on the other side of that, there's an argument to be made that you may want to just bite the bullet and pay the tax now, because who knows what happens to the capital gains rate, after the next election, if it's the end of the 20% tax, and now is the better time to pay that tax and get the step up in basis. So a lot of different creative ways of thinking about going about deals right now that are different than sort of the norm.
I mean, I would add to that. I mean, I think there's ways to be creative, and I'm sure our development team is going through that process with a lot of our investors, but we're also with large institutional banks and investors on our partnerships on the go forward. And, since 2011, we've raised $10.6 billion in capital. And so, having those strong relationships and understanding of the urban markets is important to us. And we're still seeing growth in those urban core locations and investment strategies there and focus there. Our pipeline continues to grow even in the current situation. And so I think there's a lot of positives still for the high urban core, high growth, high barrier markets of which we operate, which is across the U.S. on the West Coast, Pacific Northwest, Denver, Texas, and then up the East Coast. So I think there's still a lot of good things that are coming there in the Class A space.
Jeff, I love what you do on the sustainability front. I absolutely love what you guys have done. And walk me through how you work with your managers, your acquisition team on the sustainability objective. Like, how do you I'm assuming the team has to underwrite sustainability and certain metrics are used, but barring any specifics,
yeah.
how are you working with your team on that front?
Yeah, so we've centralized our ESG approach, environmental, social, and governance, and I run the strategy for that across the company and how we report on it and the metrics for our energy performance, as well as our sustainability green metrics, our social initiatives, give back campaigns, and then our governance of our own board, our company, our ethics, et cetera. And so to us, it's a core part of our business. High quality assets is really important to us, and working with partners to develop and build those is really important. So we get a lot of input from our institutional investors as well as to what their expectations are for deals that we go into partnerships with them on, and we clearly articulate those out to our development, construction, and operating teams to make sure they understand what those expectations are, from Energy Star to LEED, or the National Green Building Standard, or Fitwell, which is a resident wellness standard. And really understanding within those certifications what really is important, right? The thing that's most important to us is creating that value and that performance that ends up creating a sustainable asset and a great environment for our residents to live in as well. And so we build these frameworks, we build these checklist guidance documents that help our teams really understand what is it that they need to do to meet the requirements, but also what is it that they need to do to exceed them, right? And where can we go above and beyond in those, and how does that directly affect the asset? So we go through feasibility studies like anyone else, and understanding where sustainability makes sense. Again, to us, it needs to make sense financially, just like it does to anyone else. You can't just do anything you want. You need to have a good financial case behind it, but you also need to be making sure you're doing what's right for the residents in the end as well, and what's right for your investors. So we take that very seriously. It was really a fun opportunity to take over sustainability and run with it, because we're not an old company. We've been around since 2011. And we've had a lot of growth in that time frame. So really building out the framework and how we report and gather that performance metric data to drive energy savings and focus where the money meets the road and where the impact is the greatest.
Love that approach. And I want to kind of follow up with on that point. So last week I actually I hosted a panel that was very, very New York City specific in the commercial office sector. And the entire panel throughout the conversation was talking about how their lobbies have become ground zero for protecting their tenants, and their partners, and not only just the tenants, but also the people that work within the building. I live in a multifamily property and in New York, and we've seen very similar approaches. Have multifamily owner operators and investors taken that approach as well, where they're using their lobbies as like ground zero? This is where we're going to make our stance to protect our community and our residents, and we are going to flat out eat the cost. I know that impacts. This is over to everyone. Does that impact the valuation of the assets? Does that? Because I know we're trying to compress expenses here, but with COVID, there has been a rise in services provided in terms of additional services like hand sanitizers, masks, and others. Do we see that in multifamily? Is that what multifamily owner operators need to do, and are they doing that? And kind of kick it off the entire panel there.
Yeah, I mean, I think I would say that yes, we're definitely doing that. The use of hand sanitizer is spreading everywhere, right? So that's for sure one of those things. The other, though, is making sure that as you look at your building and how the residents operate within it, that you can operate in a way that's safe for them and creating a safe environment. And that may be touchless, self-touring, sanitization services, a bunch of other things that come into play there that tie to that. But yeah, the central area for, building lobbies is really important for us to make sure that is the epicenter for our associates.
Yeah, I'll jump in here too. So at the beginning of the breakout, we surveyed our clients, and both on our property management side of our business and on the investment management side. And the net result of that was that most of our clients had developed what they called like a COVID or a pandemic plan, which involved things like you're describing. And while in the short term, it may decrease to some marginal degree NOI, it seems to be that it's better in the longer term for goodwill, and it actually may end up increasing retention.
Yeah, so most of our assets were built in the 60s, 70s, 80s, and so we don't typically have like a one lobby where every resident is going through that lobby. We do have clubhouses, fitness centers, pools, and so pretty pretty quickly we closed the clubhouses and the fitness centers, and then we amped up our cleaning of hallways and disinfecting of hallways, and having a plan for the staff, because a lot of our staff works on site in the offices in the clubhouses. And so we wanted to our plan was to minimize interaction between people and then increase the cleaning frequency. So our cleaning costs have skyrocketed. And your question about, is that hurting asset valuations? We looked at this as a short-term thing, and we're not fortunately in a position where we're trying to sell something right now. So it's not like we're trying to explain that away, but I think it would be explainable, and you could make an argument that you could add that back to an NOI number and almost like a CapEx kind of charge. But we're doing whatever it takes to keep people safe. I mean, that's the number one thing. Fortunately we have pretty sprawling complexes. So the idea is that, only the people who live in a certain building are going to that hallway, and then we're doing everything we can to keep it clean.
Absolutely love that. So we can't talk about, this is a CREtech webinar. We talk about real estate the first part, but we need now to talk about some technology. Are there tools? I get asked a lot I get emails daily on what technologies I should be using throughout this pandemic, or even before, from a deal underwriting perspective. Love to get everyone's perspective. Are there any tools or technology that you're leveraging to either fundraise, manage more efficiently, manage more effectively? I kick it off to you, Jeff. Love to kind of get your perspective. What kind of technologies are you guys leveraging in-house or creating to better underwrite, fundraise, and manage your assets?
Yeah, so we have a great underwriting tool that we self-created internally and then put into a central database that we can pull all the data out of it. So my general reporting data strategy is all systems funnel into my data warehouse, and then I report out from there. Because I have multiple accounting systems, multiple different data systems that hold data. So we need that central hub and spoke model to have accurate data across the organization and can send it back and forth there. So that's really important. But on the deal management side, we do have deal management software, CRM software, pipeline management, where we can go in there and holistically look at our assets and understand what is tied to them, not only from a key attributes or information or investors or key contacts, but also the final documents that are tied to that particular deal. What are the financing documents? What are the JV loan agreements look like, et cetera, right? So we're able to put that data together, which really simplifies the process. And we're in a build out phase to expand this right now. So we have a big focus in this area so that we're able to have that full life cycle that then ties into the investor portal to be able to share that data back with the investor appropriately. So there's some interesting things that are in development there that really help us have a better view into things holistically and make sure that we have right reporting in place. Then you get down into the asset level technology that comes into play during this whole process too. And there's a bunch of interesting things that tie into what we talked about earlier with sustainability and others. But I think access control being a central point for anyone looking at this of what do I do? Make sure you have a good access control system, because it allows for the full control of all these extra services that we have trying to come into the buildings. And if you can have that in place, then it leverages you to take advantage of revenue share opportunities through these other services, or cost efficiencies or cost savings as a whole. So I think there's a lot of advantages to how to then underwrite that technology into the equation.
Yeah, so I'll follow up on that. And we are a very happy client of AppFolio on the property management side as well as the investment management side. And one of the things that really drew us, we switched a little over a year ago from another system into AppFolio, and we were shopping everybody. And I think one of the things that really hooked us about AppFolio is technological advancement. And every day there's something new, trying to make the platform better, working better for the partners and the clients. And that goes for the spectrum. And so I think that really helped us during the pandemic. One of the things we started doing is virtual tours. I think everybody started doing those, but I don't think those will go away. I think people will still do those. And that was, I mean, we were able to keep leasing momentum going that way. And so I think that will be a lasting trend. Another interesting thing is artificial intelligence leasing agents. One of the biggest problems we were having is lead follow-up. And you get 100 leads a day, and making sure that those are actually being interacted with. And so AppFolio has a tool that we have adopted everywhere, where a lead comes in and they get a text back. The prospect gets a text back right away saying, "Hey, what are you interested? Can I get you in for a tour?" And that's been incredibly valuable in increasing our traffic that actually gets in for a tour. And that we're able to then match them up with a leasing agent, a real live person, to go through that sales process. Another thing we're looking at doing is bulk internet, and something we typically have not wanted to do, but there's a lot of value there in terms of providing a lower cost option to residents. Actually, instead of buying a retail package from a provider, we're lowering their cost. But then we can also layer on top of that some of the smart home technology, because you've got the backbone there, you've got Wi-Fi everywhere, and we're in the older housing, and some of the inefficient HVAC systems and other sorts of things. So now we can layer on some cost-saving measures, and while also providing value. Sustainability-wise, we've been adding solar panels to our properties wherever we can. Illinois, in particular, has a great program for that right now, and we're taking advantage of that to help pass along savings and also make our world a little bit more sustainable. And we add a lot of cameras to properties for safety, and so advancements there have really helped us. So as much as we can, we're trying to adopt every little bit of technology we can to increase NOI.
And I think there's some interesting business cases he brings up, right? So as you look towards the smart home, it goes bigger into the smart community, right? And for an older asset, as he's referring to, just being able to change the thermostats out can greatly reduce your energy bills and your electric bills. Statistics show between 8 to 10% reduction. So right there, you're looking at a cost savings that's a bottom line, not only for the owner operator, but also the pass through to the residents. So not only does it play to the owner operator getting a cost savings, but also the residents, seeing a lower cost for their own unit is great towards your sustainability efforts of providing them a well environment to live in. So I think there's some interesting plays there. The one other thing I would add is the future of 5G and what's coming there, and how to tie that into all of this. Is going to be dynamic in how to underwrite your assets and thinking about it ahead of time. There's a lot of different strategies that are out there in the market today and how to look at those. And I think incorporating that in is going to be a big turn up, because there's going to be opportunity for rev share and other things that come in that. But bulk internet, I think, is a great way to go, just from a simple model of, hey, you can get 1 gig internet as an owner operator for $25 per unit per month, and you resell it for $55, $60 a unit per month, and the closest competition at the retail level is $65 plus a router plus what other tax services they add on to it. So not only are you bringing a savings to the resident, but you're providing a revenue vehicle. It makes a lot of sense.
Absolutely.
Yeah, and I would just add from an investment management perspective, there's some other things that you can use tools with are fundraising. Fundraising can be hard, and there's a lot of tools that can help you keep track with where you are, but they shouldn't cost a fortune. And every deal is different, and every deal takes different amounts of time. Some funds are open for a year. Some deals can close in weeks. We have an example of a client who took a 2-month fundraise down to 2 weeks. So I think there's a lot of money on the sidelines right now. Every day I'm seeing more and more companies that want to take advantage of this time to get a system in place so that when valuation sort of, what they call price discovery, when you can figure out what the value of a property is and you can agree on what you want to pay for it and what it wants to be sold for, there's going to be a lot of deals that need execution, and that's going to take investment capital. So, and that dovetails with technology like an investor portal. There's a lot of portals on the market, but the simpler the portal is, the more streamlined, the better it's designed, the easier it's going to be for your investors to pick it up and use it, both young and old. So something that can work on a smartphone or anywhere for that matter, that you can do the fundraise right through the phone with them. Also, something to think about is, you know, everyone's got a pitch book or a slide deck that they use to pitch their deals. There's better ways to do that now, and they can be more interactive. So those are some of the things that we're looking at in terms of, and that we offer in terms of raising capital and working with your investors.
I think engagement is a big key to that. And, you know, we're fairly new to AppFolio investment management, but our investors love the fact that they can log in and see their money, right? It's there and they can almost touch it and feel it. And I know that that's not necessarily a novel concept, but we use the property management side and it integrates, you know, seamlessly. And so we're providing a better level service and more transparency and engagement. People want to come back because they feel that they can trust what's going on because they know it, they can see it.
Absolutely love that, and thank you for sharing that. So we have a few minutes left, and I want to open up to audience Q&A. So if our audience has any, I see several questions came in, but if there are any additional questions, please submit them using the Q&A button. Look at the bottom of your page. A topic I want to kind of address this before we get to audience Q&A. We talked about this during our prep call, and it was about insurance, property insurance. And we had a very, very lively conversation. I said, we have to halt this conversation because it is an extremely engaging one, especially in this environment. From the owners I've been talking to here in New York and others across the country, you know, how they're going about underwriting these assets and covering these assets. A lot of these buildings don't even have 100% coverage anymore. We're seeing from providers covering their assets about 70%. So the replacement cost, they're only replacing up to 70% through an economic downturn. I want to kind of open up this conversation again because I think it is such an interesting conversation and it's such an animated conversation that I think we all have opinions on. So how are we adjusting to the nuances of property insurance, for example, premiums, coverages, and others? Jeff, you're the first one on my screen right now. Love that smile.
Yeah, well, I think Will yeah, I think Will and I had some interesting opinions on it. And what we're seeing right now in general across the insurance industry is, you know, providers are really focused on water. So that's the top priority for a lot of people is what is the water coverage look like, and those prices are continually to increase because of the amount of damages we've had over the last few years with Hurricane Harvey and others. Water is one of the most pricey insurances right now. But in general, I think what we're seeing is some pressure from investors not wanting to underwrite unless you have certain coverages. And making sure certain things are in place for their own protections as well. And so I think we're seeing that trend starting to come into play even further. You know, certain assets not being able to be underwritten because of whatever's in place there. Recently, I've heard the rumors are starting to circulate. We won't underwrite if you don't have a water leak detection program in place. So that's a direct effect to my team to design those types of things. Now, fortunately, we have a great partnership that allows us to put those in place, and we have those rolled out to multiple communities. But having those type of programs in place are now a requirement to be underwritten for insurance, which is a new trend that I think we're going to see more of, not only in water, but outside of water too.
Yeah, so we're also seeing skyrocketing premiums, and I think it comes down to simple supply and demand. There are fewer carriers out there that want to play in this space. I mean, especially as I mentioned, we have older assets, and you know, not fire sprinkled and all the latest and greatest. So there's just less of a desire to write insurance for these properties. So the costs are going way up. I give a recent example. We had a deal that actually fell out right at right at the beginning of the coronavirus, where we typically underwrite $275 to $300 a unit for insurance. We ended up, like, our best quote was at $550, and that was including, we have hail coverage is really big out here in the Midwest, and there was $100,000 wind hail deductible, and a much higher normal deductible than we would have paid. And we would have had to pay $700 a unit to get that. So you're talking about $300 to $700. I mean, that blows up your underwriting. And now we're $390 to $400 standard, and we are starting to get quotes, hard quotes, before we even offer on a property. And so there's a lot of due diligence that's going in the front end. We're underwriting bigger year-over-year increases. I've heard that, it's not going to be 2%, it's going to be 5% year over year. So that's really impacting, I think, valuations right now for acquisitions that are going on right now. People are thinking about COVID. They're also thinking about, what is my insurance going to look like? One of the things we're looking at doing is adding a requirement for renter's insurance. It's not something, we're in a more of not capital A affordable, but more like attainable, affordable is, kind of housing people can actually afford. And we try not to add too much in terms of additional costs on top of just base rent, but we're going to have to do something to protect the bottom line, and renter's insurance at least is a benefit to the renter as well. And that'll help cut down on claims we make in the future, and hopefully keep insurance costs down. One of the big things, without having sprinklers, we are looking at adding kitchen fire suppression systems, and you can actually lower your premium quite a bit by, it's sort of like a little fire extinguisher that's over the stovetop, to try to cut down on premium. But there's a lot of uncertainty about do I underwrite this forever, or is this a temporary thing? So I think that it's going to impair acquisition values, at least in the short term, until hopefully some additional carriers come into the market and become innovative, and competition happens again. But it's certainly a challenge for us right now.
Preach, Will. Absolutely preach. 100% agree with you. 100%. So a few questions came in. I want to absolutely touch on a handful of these. First question: is this webinar being recorded? Yes, and we will share it at CREtech.com/events, so you can check it out there, and also live on YouTube. And if you're a subscriber to CREtech, just go to CREtech.com and you can subscribe there, and it'll be delivered to your inbox. Karen asks, with curtailed travel given the pandemic, including restrictions, how are the panelists conducting market level analysis from their remote locations?
I mean, I'd add our
technology
advantages. We have, our competitive advantages are local teams. And so we have people that live in every market we operate, and they still are able to, drive places, but leverage technology and webinars and go-to meetings and, Zoom calls, et cetera.
Yeah, similar. As I mentioned before, we're not more than 2 or 3 hours away from any market that we're going to acquire in the short term. So it's easy to drive over to Indianapolis and be on the ground. But I gotta love Street View. I mean, I live and die by that now. I mean, unfortunately, some of the images are outdated, but a lot of Google Earth and we have some technology where we're overlaying census tract data over top of maps. And so we don't necessarily have to be there to understand the demographics of even a tiny block of a submarket. So fortunately, a lot of what we were doing even prior to COVID was from afar. And we have, as Jeff mentioned, we have local teams. We have people in these markets already, and we can say, hey, what do you think of this cross street, and what's the reputation of that complex? And so again, just leveraging data on the internet and personal experience of our people on the ground.
Local market expertise, 100% agree with you. I think is key. So last question. I know we're a few minutes over, but what is the biggest takeaway that you will apply to future deals? Will, you're the first one on my screen. Let's lead off with you.
Sure. No, I think that what I realized very fast when things were changing every day is you have to have your finger on the pulse of what's going on. You have to look at everything. I mean, I've watched every webinar that's out there, just trying to absorb information of what people are saying, reading every tweet, every article that comes out, any insight, even if it's an opinion piece, just trying to just gather information about what do we do next. And this is internally too. Now, I get an email from AppFolio actually every time a lease is signed or an application comes in. And for me, that's, I'm an investment management professional, but not a leasing person. But that tells me, like I mentioned earlier, we're having a huge uptick in student applications. I don't have any data aggregator. I'm looking at my emails, I'm getting that, and I'm feeling that pulse. And so I'm able to make decisions based on what I'm seeing in our own data. But I think the biggest thing is learning from each other. Having conversations about what are you seeing, what are you doing to adapt, because we're all in this together, and that's the way it's always going to be. And so I find these type of discussions incredibly valuable for just trying to decide what to do next.
Mike, Will, and so Will, you just ended. Mike and Jeff, love to kind of lead off with you guys. Let's kind of get your perspective on what you guys are seeing and what you're going to take away from this pandemic.
Yeah, well, my shameless plug is putting technology and sustainability into all the underwriting efforts, right? And 100%. Making sure the teams are educated on how to do it early enough in the process, that it makes financial sense, that we're able to actually show ROI. One of the things I take pride in my team's ability is really the fact that we think about it from a hard dollars, real business case perspective, not just what's shiny and cool and wows people, but what actually provides financial returns. And so as long as we keep that focus, I think we can make really positive impacts to the underwriting process.
Mike, you have the final word.
All right. Well, I'll give my shameless plug too, although I kind of did that earlier as well. So, so I would just say that, in this sort of current COVID and post-COVID world, things may or may not change long-term in terms of working from home or just having more mobility. And I think we've seen a lot of clients that have taken advantage of that and been able to successfully execute and thrive during this time. As a company, we're a software company. As a company, we have over 1,000 employees. We're all across the country completely working from home still right now. And so we have a lot of experience in going through this ourselves, and that kind of finds its way into the software. And so we work with our clients to make sure that no matter whether you're going back and forth between the office and home, or just working from home or going back to the office, we have this solution for you, and we have the solution for your investors. So I'll leave it there.
Thank you for the good word. So that's all the time that we have for today's conversation. Mike, Jeff, and Will, thank you all for sharing your thought leadership. And thank you to AppFolio Investment Management, a leader in investment management. I hope everyone, including our amazing audience and community, had a great time. I certainly did, because I actually learned a lot. Again, my name is Ashkán Zandieh, and it was a pleasure to be your host today. Thank you to our amazing audience and our thought leaders today. Thank you, everyone.
Thank you.
Thank you all.
Bye-bye.
See you guys. Bye.